Hi, I'm Ed Alexander, founder of the Entrepreneurship Law Firm. In this video, I'm going to talk about the process for raising equity growth capital for your business. First question we have to answer: is the company a candidate for an equity offering? There are certain key characteristics that companies have that make them readily available for equity investment. Then we need to determine how much money needs to be raised and what's the value of the company for investment. This is going to determine how much equity has to be given up in order to raise that capital. And then we need to plan out, what does the company look like from an investor perspective? What are the investors going to think, and how can we minimize the problems with the company? There are really important characteristics about your company that any investor is going to need to know before they'll do an equity investment. The first, and perhaps most important, is whether your business is scalable. Can your business grow to a large gross sales number in a very quick period of time and without a lot of high-end talent? If you think about some of the businesses that are scalable, you'll see common characteristics. These are typically not businesses that require multiple high-end locations with lots of build-out, or that require highly trained employees to make the business work. Next, you want a business that has a high gross margin. Remember, gross margin is what comes after you pay the cost of the service or the cost of the product. So you take gross revenues, you deduct out the cost of the product, and you have gross margin, or the gross cost of the services, you have gross margin. Your gross margin to be eligible for an equity investment should be no less than 65%. So this means for every dollar that comes in, you only pay 35 cents for the cost of the product. Now, those expenses don't include the back office, the marketing, the sales, or what we would call sales, general, and administrative expenses. But you need to have that high gross margin. Next, you have to have a management team with a proven track record. That means people who've done this before. Now, usually I hear from entrepreneurs, they'll say, well, wait a second, does that mean that as a first-time entrepreneur, I can't get equity financing? No, not necessarily. You can get people who have a proven track record, whether in your industry or in the entrepreneurship realm, by bringing them on as advisors to your company. And then finally, you as an entrepreneur need to be coachable. This means you need to take advice and suggestions from your team, from people who are qualified. And this can be tough for some entrepreneurs. Being an entrepreneur means you're probably headstrong and set in your ways. But building a high-growth, valuable business is a team sport, and you've got to be able to take input. Well, thanks for watching. In our next video, I'm going to talk about the different types of investors and which ones you should look for.